Good day, fellow investors. In this video I want to discuss buybacks, the pros and cons, because I simply can't wrap my head around that. If we check how buybacks have evolved, let's say over the last 20 years, where there has been a real boom in buybacks, we can see that when times are good, buybacks are extremely high, like now, and buybacks are now double what dividends are. Almost double. So the 2022 922 billion spent on buybacks, new annual record, and dividends set at 564 billion for the S&P 500. Of course, buybacks have tax advantages, so you don't pay any dividend taxes. If the total number of shares out there is smaller and smaller, you own more of the company, thus you benefit there from capital gains rather than dividend taxes. And of course, the stock goes up, buybacks push the stock up, you own more of a company, and that is nothing wrong with that investment strategy and tactics. And even Warren Buffett confirms it in the last letter to shareholders. The math isn't complicated. When the share count goes down, your interest in many businesses goes up. However, there is also the next part of the paragraph that I want to focus on. Every small bit helps if repurchases are made at value accretive prices. I repeat, if repurchases are made at value accretive prices. Just as surely, when a company overpays for repurchases, the continuing shareholders lose. At such times, gains flow only to the selling shareholders and to the friendly but expensive investment banker who recommended the foolish purchases by Warren E. Buffett. And that's exactly what I want to discuss. Value accretive prices. The stock market is now close to all-time highs. Where are buybacks? All-time highs. When the stock market is at close to all-time lows, relative comparatively, where are buybacks? Buybacks are down in the dumpster. We just discussed Apple, and they are pushing on those buybacks now. The P ratio doesn't matter of 31, nothing matters. But who doesn't do as many buybacks as he used to do? Well, Warren Buffett. Now he thinks Berkshire is too expensive and he is lowering the amount of buybacks. Completely counter than what S&P 500 companies are doing. And I can understand Buffett. Berkshire is Berkshire. Berkshire will be there 20 years from now, 50 years from now, because it is set up in such a way. However, we just discussed Walgreens Boots Alliance made an analysis, and they made huge amounts of buybacks 2017, 18, 19. 2017, 18, 19, when the stock price was close to 80 and far from the current 20. Now they are thinking of stopping buybacks or at least keeping them at 150 million, not 5 billion. If they had done the opposite, that would be something spectacular. But with 14.5 billion spent in 3 years, they bought back 15% of the company. 15% with 14.5 billion if you look at the number of shares outstanding. Now 15% of the company is 2-3 billion. So they spent 14.5 billion and now the market cap is 18 billion. Can you see here the value destruction? They could have used the money to repay debt, do better acquisition back then rather than now. But the problem is that the management is paid to always think that the stock is cheap. Here or here. If they say here, oh, the stock is expensive, we are not going to do buybacks, the stock goes down, they get fired, and someone else comes in their place that will say that the stock is cheap and let's push buybacks, let's push the stock higher. That's what all short-term investors want. But there is a cost to it, and that cost is that at the moment cash flows for buybacks dry up, like the last few years, then this follows. The same that pushed the stock higher at the beginning, everybody happy, when those dry up, that things destroys value. And yes, the manager will always say the stock is cheap, but that's not investing, that is speculating. And if most managers, CEOs speculate with buybacks at the wrong moment in time, there is a lot of value destruction there, long term, not short term, of course. Short term, the stock goes up, as we have seen with Apple, and everybody happy. Let me give you just a theoretical suggestion to Wall Street here. Berkshire stock is now up and higher because Berkshire shareholders know that if Berkshire stock drops, Warren Buffett is going to protect it and do huge buybacks with the cash that he has there. Now, isn't that a much less costly strategy, actually a beneficial strategy, compared to what Apple is doing and spending 100 billion now on buybacks, that if the stock goes down or the business just slows down a moment in a few years, all those buybacks get destroyed. So, Tim Cook, just something to think about. Just say, when the stock price is right, we will do the buybacks. You can save 500 billion, and then if it crashes, then you buy, and you do a good thing for long-term shareholders. Because this is exactly the opposite of what Warren Buffett is doing. And if I look at the earnings as reported, 1.6 billion, buybacks 1 billion, so 66% of earnings are going to buybacks, let's say. Of that, I think that 95% is destroying money, which means that actual S&P 500 earnings are around 700 billion. And that makes the situation even more riskier. More than 90% of buybacks destroy value, in my opinion, because buybacks at whatever stock price is not value accretive, as Warren Buffett says, but it actually destroys value because it implies that that business will forever be in the same environment. And all businesses are cyclical, which means that the same environment will not be there forever. And here is just one example. Top 10 S&P 500 components for 2000. Well, let's compare it to the current. General Electric, ExxonMobil is still around that market cap. Pfizer, Citigroup, keep that in mind. Cisco was booming back, going down, then a little bit up. Walmart is still around. Microsoft is now at the top. Okay, that's one. AIG, Merck, okay, around. Intel is also below these levels. So, in the next 20 years, how many of these companies will be at the top 10? Now it looks like those are undestroyable, but the same could have been said 23 years ago. So how many of these will survive? Only time will tell who will survive, but the key is that most companies think they will be there, but the reality is they won't, and therefore all buybacks here are too risky and value destructive on aggregate. Because the reverse should be done: buy more when ugly, not when great. Nobody thinks about price except Warren, and management's incentive is to push the stock higher in the short term, destroying value. They get their options, but they destroy value for long-term investors. They destroy value for pension funds because buy more now and much less when things are cheaper, and therefore I think that this is something that over the long term will not be a positive for the market. However, I love buybacks too. If the buybacks are done at the same price that I would be happy buying the stock, that's a great thing. Warren Buffett looks at Berkshire and they say 8 to 10% returns, so now we are around 5% returns given the adjusted P ratio of 20. So if it is around 15, he will start again to do buybacks, and if it is around 10, he will buy. That's 50% down from now, like it was in 2020. He will buy a lot. And that's something that has worked for Warren Buffett. I think that the rest of the company there is destroying value. This is, of course, just my opinion, but if you are a long-term investor, it's very important to understand when you just ride the buyback tide and take advantage of that, because if it is value destructive, the only benefit you can get is by selling. If you are a seller to a company doing buybacks, like Apple, thus Apple is a sell if you want to take advantage of that value. If you bought a few years ago, now it's time to sell from a risk-reward perspective. This is my opinion. Thanks for watching. I'll see you in the next video.